Let us examine the psychological impacts of stock splits, on investors and traders. The psychological impact of stock splits on investors and traders. Number one is the introduction. So stock split can have a significant psychological impact on both investors and traders, even though they don't change the fundamental value of the company. So understanding the psychological effects is crucial for interpreting, market reactions and making informed decisions. Number two, what is a stock split? What is a stock split? A stock split occurs when a company issues additional shares to existing shareholders. In Nigeria, we call it bonus issues. Bonus issues. For example, in a 2-for-1 split, shareholders receive one extra share for every share they own. For every share they own, you have one extra. If you have two, you have two extra. And so the share price of the company in that respect is halved, is kind of divided into two. If you had one at maybe $10 and they give additional one, you have $5 each. So it is like divide by two. The total value of the investment remains unchanged, but the perception of the stocks may shift. That is it. The investment remains the same, but the psychology, the perception behind it, could change. Number three, psychological effects on investors. The psychological effect of stock split on investors is that perceived affordability. Is that perceived affordability. So a stock split makes share more affordable for individuals, for individual investors, which can create an illusion of a better value. So lower price shares may seem more accessible, even though the overall value of the company, has not changed, still remains the same. And so this can drive new investor interest and potentially leads to higher demand because investors feel the price is now down. They can rush into the stocks and then force the price up. There's an increased investor confidence. Many investors see a stock split as a positive signal. It may be interpreted as a sign that the company is performing well and expected, to continue to grow. This can boost investor confidence and increase, buying activity. And not only that, there's satisfaction and optimism. Satisfaction and optimism. So in this case, investors may feel more satisfied with their holdings after a stock split becomes because they now own more shares. That's plain psychology. They own more shares, even though the overall value remains the same, but they feel after all I've been given what is called bonus in my country, Nigeria. I've been given a bonus. This can boost investor confidence and it makes them happy, develop more confidence in the stocks, more optimism, and so this can generate a feeling of optimism and encourage long-term investment. Is that optimal joy, and then it encourages investors to invest the more in the shares. There's this behavioral bias. In this case, some investors may fall into the illusion of wealth. The illusion of wealth bias, thinking that owning more shares equates to a larger stake in the company, even though their proportional ownership has not changed. This can sometimes lead to irrational decision making. People feel that they've kind of created wealth when in the real sense they've not. Their Value, the value in the portfolio remains the same. Nothing has really changed per se. Number four is psychological effect on traders. Psychological effects on traders. In this case, you have on short-term speculation. Short-term speculation. Traders might be attracted to a stock split due to the short-term volatility that often follows the announcement. The volatility, give an opportunity for wealth creation. You could buy at the bottom and sell at the top. And so the increased liquidity and the psychological effects on other market participants can create opportunities for speculative trading. The traders may take opportunity of the volatility, inherent in the stock split, and then could benefit from them. There's momentum trading. It encourages momentum trading. So traders might expect the stock price to rise in the short term, driven by the increased demand from retail investors. This creates, a potential for momentum trading where traders buy in anticipation of a quick gain. Then you have overconfidence. Overconfidence. The traders may overestimate the potential impact of a stock split, assuming that the market will continue to react positively in the long term, which may not be the case. So this overconfidence can lead to poor decision making, especially if the stock doesn't, continue to rise after the split as expected. Please like this video and subscribe to this channel. Number five is impact on market sentiment. Impact on market sentiment. In that case, you have what is called herd mentality. The announcement of a stock split can lead to a herd mentality where investors and traders follow the crowd, buying the stock simply because others are doing so, not based on critical thinking. So this can cause a temporary increase in the stock price, driven more by psychological factors than by the company's underlying fundamentals. Then there's that FOMO, fear of missing out. Fear of missing out. Some investors may rush to buy shares in the hope of capitalizing on the stock split, price movement. This behavior is often driven by fear of missing out and can lead to short-term volatility. Then number six, the long-term view. The long-term view. While stock split can generate short-term excitement, the long-term impact on investor sentiment depends on the company's actual performance. That is what matters. The actual performance of the company, not just the action of implementing a stock split or issuing out bonus shares. Once the initial excitement fades, investors and traders will focus on the company's fundamentals. They will come back to what really counts, such as earnings, cash flow, and the overall financial health of the company. Number seven, in conclusion, stock splits, have a strong psychological impact on both, investors as well as traders. They create, a sense of affordability, increase in investor confidence, and it might lead to, to short-term speculation. That is it. So whenever there's a stock split, you should actually ignore it and consider the fundamental performance of the company. That's what really counts, and not just, should I say, gimmick of a company issuing, bonus shares or what is called what is called stock splits.